Just to let everybody know that this presentation will be recorded. We will be making it available as a podcast and be putting it up on my web page so that if you want to have access to it later on to either review any of the information or if you'd like to use it for future training purposes with other people within your organization, you're welcome to do that. And all you have to do is go to the Brian Cave website and go to my name, and you will see on the right-hand side a list of various podcasts that I've done, which include presentations such as this, and you're welcome to use them for any type of purpose that you think is helpful to you or your organization. Okay. We got one more person settling in here, so you're gonna let him stop pouring ice and pouring drinks and popping tops, and then we'll get started. I'm going to go now to full screen. The last thing that I want to encourage everybody who is on the phone to do, as well as those people who are participating live with us, is please feel free to ask questions. I will try to pause in between slides, and if you have a question that's relevant to something that I've just spoken about or an issue that I've just raised, please feel free to ask that question when it hits you, because sometimes it's hard to remember your questions to the end, and I'd rather deal with them in real time, both because I think I can give you a better answer and put it into context, as well as I think it helps you ask the question that is really on your mind. So the issue that we're going to be focusing on today is related to guarantee liability, third-party liability, and entity formation, and how the three overlap when you're underwriting and trying to determine where you're going to be your primary and secondary sources of recovery on a loan. And this is particularly focused on loans where you have real estate collateral. So one of the things that we will be spending some time on is we'll talk about the different types of entities that are formed and what type of liability protections the owners have or don't have within those entity formations. We'll talk about not only the entity types, but how they're managed, how investments come into and go out of the entities, and how that affects some of the things you should be considering both in your underwriting as well as in your loan documentation and structuring. We'll also talk about some of the things that you should consider when you're structuring a deal at the outset that may be issues to pay attention in terms of anticipating a potential loan workout. Again, the structure of the entity and how you allocate liabilities between the entity and tertiary parties such as guarantors are important, as well as the ownership, management, and control issues that are built into the various entity types and how you can manage those. Finally, I'll spend a little bit of time and talk about or weave into the presentation single asset or single purpose entities, what they do, what they don't do, hopefully correct some misimpressions about them. The number one of which is you will hear them referred to as bankruptcy remote entities. I want to make very clear that that does not mean that these entities can't file bankruptcy or are unlikely to file bankruptcy. In fact, the opposite is true. Because they hold one asset, they are more likely to file bankruptcy, and they are bankruptcy encouraging entities, but the assets that will be subject to the bankruptcy will be limited to just those assets that that entity owns, which can be an advantage to you in the bankruptcy context because there are special rules that expedite bankruptcy for single asset entities, which gives some benefits to lenders in this context and help you manage the process more aggressively. So notwithstanding the fact that the bankruptcy remoteness means that you're separating the asset that this entity owns from the rest of the portfolio of the underlying owners, that's the bankruptcy remote characteristic, that can very often be advantageous to you depending on the rest of your entity structure type. Going into entity structure, what I want to point out is, and what I hope to leave you with, at the end of the day. So I'm going to jump to the ending and then build to it. I had a professor that called that circumlocution. You start at your ending and then you go in a circle and hopefully end up in the same place. So I'm going to presage that a little bit by letting you know that we are not here as part of this process to advocate that there is a particular type of entity that is better than another. There is a particular type of entity that you should be steering your borrowers to be into or not be into. What we're really trying to do is explain to you what options you have with the various entities, how you can structure around some of the limitations within those entities, and how you can maintain the appropriate lender controls and lender supervision of these entities without stepping into lender liability issues. So at the end of the day, you can give me just about any entity type, and I can help you structure a loan transaction that will get you recourse to the assets that you want to have recourse to in nearly all instances. So there is no right answer, but there are different ways to get to those conclusions depending on the entity type. So what I want to spend a moment on is, why do certain people pick one entity type over the other? And you need to understand the motivations of your borrowers when they are forming their entities so that you can understand what type of issues to anticipate from your documentation standpoint. So certainly one of the aspects is tax considerations. When you have a subchapter S entity, when you have a partnership entity, when you have an LLC entity, all of those are considered pass-through entities, meaning the entity does not pay tax. Rather, whatever profits and distributions flow through that entity to the owners, that's where the taxing is. It's one level of tax, and it's at the ownership entity after they receive their distributions that pass through the entity. So tax considerations are one of the key things that people consider in whether or not they're going to have a corporation, let's say, versus an LLC or a partnership. Because a corporation has two levels of tax. The corporation is taxed, as well as then the distributions are taxed on a personal level for the owners. And so that would be one of the downsides of having a corporation. There can be some upsides to a corporation, which we'll talk about in terms of the type of business you can do and how you structure the way that money goes into and out of the entity. But that's one of the key considerations, and that is the tax structure and what the owners are looking to do. In addition, the active versus passive management. In a corporation, for example, you have shareholders, and unless it's a closely held corporation, if it's a larger investment vehicle, people will choose a corporation because the shareholders can be passive investors and you can have professional management in terms of C-level executives that run the business. You can also, however, accomplish the same thing with an LLC. Now, you can't do that with a partnership. Partnerships have to manage their own business. They can't outsource the management of their business, but an LLC can, because you can have a non-owner or a non-member manager of an LLC. So an LLC is nice because you can get the tax pass-through benefits of a partnership with the LLC, but you can have the third-party management and outsourcing of management and pay a fee to a third party to manage your entity and have a more passive role like you can in a corporation. So it's a nice hybrid entity. Also, people will use the type of entity that they're going to form sometimes with estate planning considerations. And this is where you see family limited partnerships, because family limited partnerships allow you to have a 1% general partner that is a corporation, and it's typically owned by the parents, and then they have both the parents and the children who are limited partners in that partnership, and over time they gift greater and greater limited partnership interest into the children from the parents, and they do that to avoid taxation and to shift ultimately the beneficial interest and the ownership interest in the benefit of that entity through a family limited partnership. So estate planning can be one of the reasons you choose an entity type over another. And finally, there's going to be the relationship between the co-investors, managers versus non-managers. For example, if I'm a promoter and I'm going out and I'm looking to find an asset, but I want people to invest, and effectively I want them to invest but have little or no say in the ownership of the entity, I will most likely want to have an LLC where I'm the member manager, and they are non-manager members where they have limited say in the operation. One of the advantages that you have over an LLC is you can also reallocate the profits different than the ownership interest. So in a partnership, if you have 4 partners that each own 25%, you need to share the profits of that partnership 25% per partner. But in an LLC, you can have people that invest, for LLC members that invest 25% each of the initial capital, but you can have different levels of owners that get preferred returns or get lesser returns on their investment of the capital up front, very similar to a corporation. So the management issue and the capital investment and the capital return issues are things that you can address through your entity types, and LLCs tend to be more flexible like corporations than partnerships are. On management issues, to me, as a lending lawyer, as a bank lawyer, I am most interested in understanding the stability and the continuity of management. I understand that when you guys are underwriting an entity, you're underwriting it in part on your relationship with the managers, the experience of the managers with the assets, whether it is a business that you're funding with a capital or working capital loan, or whether it's a real estate loan where you are basing your loan on their ability to develop the real estate and or manage income producing property. So one of the things that we want to pay attention to, and we do this through the due on sale provisions, is who are the managers, what changes are permissible in the management, and what changes require lender approval. And here's what is important to know about this. Whatever they put in their agreement, you do not have to follow in the controls or limitations you exercise in your loan documents. But if you are silent as to what limitations you want to have in terms of their change of management or change of control, then their documents will control. So for example, if you have a manager member that you know is a good manager and you're depending on them to manage the asset for you, but they have an investor who has the ability to push them out of that management role if they're unsatisfied with the return that they're getting. If you do not address that change in management in your loan documents, they will be able to make that change without your consent because they will be acting within their documents. And in fact, they can even later amend their documents to provide different change in management provisions. And if you do not anticipate how you want to control that process up front, you will be subject to whatever they have in their documents. So typically we look at an entity and we want to make sure that the current management team stays in place, as well as the current ownership structure stays in place. And if they are going to be changing a majority of the ownership interest so that different people will be controlling the business decisions, or if they will have the right to change management, we deal with that through limitations and covenants and permitted transfers or not permitted transfers within the entity. That's part of the loan documentation, and this applies both to commercial loans as well as to real estate loans, because again, I understand you're underwriting on the strength of the management team.
Hey, Rand, when you're talking about changing the management, you're also referring to non-owner officers, like if the company's got a particular CEO or CFO that they want that helps the company succeed, it's maintaining those people also in there, correct?
Yeah, very often it depends on how you want to drill down, but for example, in a corporate borrowing situation, it would not be unusual for us to put in a provision that says they cannot change the board of directors, or any of their C-level officers without the prior consent of the bank in its reasonable or sole discretion, depending on how much control you want to have. Now, they may have key people that they're going to tell you, we promise that our CFO will stay the same, our president will stay the same, our VP, but we may want to change our treasurer, we may want to add new VPs, etc. So we can play around with that concept, but you're absolutely right. When we're looking at the entity, we're looking at the decision makers, the board, or if we're looking at an LLC or partnership, we're looking at the general partner structure of that partnership as well as the management structure of the LLC.
And what's the likelihood, in your opinion, that a judge would let you enforce a default on a covenant that dealt with management or ownership if there's no payment default?
If you are clear and specific in what your restrictions are, the cases, particularly in the Western states and Midwestern states, are very favorable for the lenders in enforcing these provisions. So, for example, if you're vague and you say, generally, no change in management, that may be something where you would be subject to ambiguity and a court would not necessarily rule in your favor. But in the example that I gave where you said no change in your C-level officers, no change in members of the board of directors, no transfer of more than 49% of the voting stock or 25% of the voting stock, no change in your manager of your LLC or of the officers of the corporation, which is the manager, you can drill down several layers. And as long as you're specific, there is good case law that upholds having those enforceable as defaults, even though they're covenant defaults, in your documentation, because the courts have recognized that lenders are not just loaning on the assets that they may take as collateral, but that part of their decision is on the strength of the management team. So the key is looking at it, discussing how specific you want to be, while giving yourself some flexibility. You don't want to be overly specific by naming people by name. It's best that you pick the type of decision makers and the type of control that you want to have, and if you spell that out, it is absolutely enforceable, and there's good case law on that. So we feel comfortable in recommending that, and we personally have had good success in using that in litigation that we've been involved in. So I would endorse that as something to take very seriously because it is a real tool in your tool bag. Capital funding is important. How is the equity coming into the deal? Is it coming in up front? Is it coming in over time? If it's coming in over time, do you want to monitor that? Do you want to have some kind of control? It very often is the case where there is an investor that says, I'm going to invest $5 million up front, but if there are business overruns or there are working capital needs, or if you're building a project and there are cost overruns, we will fund those. Very often, we have been able to structure with that investor member a direct tri-party agreement between the bank, the borrower, and the investor for what we call a capital funding or investment funding agreement, where the bank itself has the right to call directly on that investor to put up the funds that they have promised within the organizational documents to provide, and to give you direct privity to enforce those obligations so that you can make sure that the capital comes in. So you want to look at the timing of how the capital comes in and determine how much control you want to have or not have on that. Do you want to leave it to covenants, which gets to your point, I think, that covenants are sometimes not the best triggers for default? Or do you want to have a direct privity relationship where then there's an obligation to fund that goes directly to the bank, which then becomes a payment default and is much easier to enforce? Now, there's a lot of negotiation, obviously, to get a third-party investor to agree to that, But I can tell you, we negotiate a lot of those agreements and have quite a bit of success in getting them. So it is possible to do it, and we're not talking about theoretical here. We also want to look at the role of whether capital is coming in as an investment or as a loan. If they're going to have the ability to make loans, we want to make sure that our guarantees and our loan documents expressly subordinate those obligations. And if we have pre-existing investor loans, we will expressly subordinate those in a separate document up front, because the basic rule is you want the money from the operational entity to come to pay your debt first before it goes to the investors. Now, that's a basic principle in bankruptcy, but you bolster it, of course, when you have that contractual angle also. Finally, the permissibility of investor distributions. Do you want to limit distributions to investors until you're paid off? Do you want to limit distributions as long as you're not into default? In other words, they can make regular distributions of profit as long as the bank is being kept current under its obligations, but under a default, they can no longer make distributions. If you put that right in, do you want a right to claw back any of those? Those are considerations to think of in terms of how the money flows out of the entity as well as how it comes in. And again, to answer your question, if you are specific in describing what it is that you are limiting and what the rights the lender has to either prevent those or claw those back. And it's very simple to do. You say once there is a default, any monies that are paid to you, first of all, you're not, as an investor, you're not going to get any monies, but to the extent that you do, you will hold them in trust and pay them back to us. That is an enforceable provision, and courts will enforce that level of specificity. So you can include that level of clawback. Want to spend just a little bit of time, because I've covered a lot of these issues already, but corporations and limited liability companies, both of these are entities that walk and talk a lot the same in terms of the owners have protection against third-party liabilities, so they have that shield against liability. They can be owner-managed or third-party managed, and so the lender has to pay attention to, is this owner-managed or third-party managed? If it's third-party managed and there's actually a management agreement, we will want to have that subordinated to us. We will also want to limit how they change that manager. Up front, we always want to make sure that we have them declare to us who's authorized to sign, and that we want to give ourselves the right to presume we can rely on those signatures throughout the life of the loan unless they give us written notice of any changes in the authorized signing parties. In other words, we want to create that authority up front and allow ourselves to rely on that and not have to reaffirm that authority every time going forward. We talked about changes in management. The only point I want to make here is, to me, if you have an investor member who has the right to change the manager and either replace them with themselves or a third party, you have in effect a prearranged workout. And in all the time that I've represented banks, I have never had a bank tell me that their loan approval also includes a prearranged workout. I know you guys do not have prearranged workouts. Hence, if we see those type of change in management, change in control provisions, I can assure you that we will have the conversation with you about the type of limitations that we want to exercise, because what they will want is the ability to do this unrestricted. What we will want is to not allow them to do it at all. And where we will meet in the middle is we will set up parameters and give you the right to look at the situation and approve the situation at the time of the change in management, provided they do things like cure any outstanding defaults, allow you to review and approve any replacement manager. If you have ongoing expenses that need to be paid, that those are paid current. that they give you a business plan that they are going to be using going forward, and you have the right to review and approve that business plan. Those are the type of parameters that we think about that meet in the middle and tell them, we're not going to tell you no, but we're not going to give you a blank check. Yes, this is going to be a collaborative process over which we are going to get the right to review it at the time and make a business judgment as to whether this change in management is best for either the entity that we've loaned against or the assets that are collateral. On general partnerships and joint ventures, the only issue I really want to make is you want to be sensitive to the ability to bring in new partners or replace partners. And generally, if you have a general partnership or joint venture, each of the partners are both personally liable as a joint venture or general partner member of that entity, as well as the entity and its assets are separately liable. So if they are going to be adding new partners down the road or replacing new partners, you need to make sure that you are having those new partners reaffirm their obligations as if they were an original partner and had the liability from day one. So we will want to make sure that as they are changing parties down the road, even changing because of death, that the new partners who come in are reaffirming their obligations. This is particularly true when you have a general partnership or a joint venture that owns the assets that are pledged as collateral, and this can be real property or personal property assets.
Ren, I have a quick question.
Yes.
If somebody comes into a general partnership as a new general partner, are they not automatically by law obligated personally?
Yes, they are obligated personally by law going forward. I think the important point that we want to make sure is if they are coming in and that entity owns the assets, we also want to make sure that we get a granting clause from them that they are expressly acknowledging that they are pledging those assets that they have an interest in as a joint venture partner or as a general partner.
Okay.
If you have a general partnership, is it redundant to get a guarantee of the general partner or possibly even harmful for you to do that?
Yes, let me talk about that in two contexts. Let's talk about that in the non-real estate context. In the non-real estate context, a guarantee of a party's own debt, so since a general partner is already liable, its guarantee doesn't add anything new. It's not illegal, it's not improper, and there are times where we have had banks say, we want to make sure they know they're personally on the hook, so although the general partnership signs the loan documents, we are asking the general partners to sign guarantees. As long as you understand you're not getting something extra on top of it, there's nothing improper in having them sign a guarantee or illegal in having them sign a guarantee. It changes a little bit when you have real property as your collateral, because particularly in western states where we have a one-action rule, that's going to be Nevada, that's going to be Utah, that's certainly going to be California, that's going to be Washington. In those states, you want to be careful because a guarantee by a party that's already liable typically is going to include waivers to get around one-action rule protections. And those waivers cannot be given at the making of the loan. So it generally is perceived to be improper.
Because they're above the law.
Yeah, because you're trying to get around the law, and not only will that guarantee be held as unenforceable, but it typically is viewed negatively by the courts as if you've tried to sneak around the back door. So I would be very careful and would generally not advise, if you have a general partnership or joint venture, that you have or even a limited partnership, having a general partner also sign a guarantee if real property is your collateral or even part of your collateral. And I want to make sure that's clear, because you can maybe have your primary collateral being the assets of the business, and then you take as an abundance of caution a deed of trust on their property. The message I want you to take away from today is, in one action rule states, there is no such thing as abundance of caution. Once you take that deed of trust, your loan becomes real estate secured as if that were the primary collateral, and that will control the way you have to behave thereafter. So in your mind or in your underwriting, it may not be your primary collateral, but as far as the law is concerned, you now have a real estate loan and you have to treat it that way as if it were your primary collateral.
Ryan, just one follow-up thing, because I don't want to throw the abundance of caution out there. But also when you've got, various unsecured lines of credit, a lot of times someone will say, let's take a third deed of trust on this property. It's got a little bit of equity there, and you run into the same issues that Ryan's talking about right now, where it really restricts, and alters the way you can enforce your remedy.
Thank you. Intercompany debt, I'm switching now to reaching beyond the liability shield. On intercompany debt, if you're in a bankruptcy situation, there is well-established bankruptcy law that says generally the creditors are to be paid before the investors are to be paid. In addition, payments made to investors have a longer preference period than to third parties. So when an entity files for bankruptcy, if you're a third party that's received a payment within 90 days before the bankruptcy, it is potentially considered a preference and can be clawed back into the bankruptcy estate. If you are an insider and investor, that 90-day period is extended to a year. However, we would recommend that for intercompany debt, it is important to have subordination agreements, notwithstanding those rules, because you don't always end up in bankruptcy. There may be a whole variety. You may have a multi-asset entity with a variety of investors that invest in a variety of properties, and they do not want to put it into bankruptcy because they do not want to put their whole portfolio into a bankruptcy. And you want to make sure that you get the same protections that we just talked about in a bankruptcy scenario by contract in a subordination agreement. Because again, subordination agreements in commercial loan transactions, whether they're real estate or non-real estate secured, are generally strictly enforced by courts because they're deemed to be between sophisticated parties and part of the expectation of a reasonably prudent lender and a reasonably sophisticated investor. So you want to make sure that you get those subordination protections by contract and not rely on the fact that if everything fell apart and you ended up in a bankruptcy court, you would have certain protections, because you don't always end up there. And you want to be able to protect yourself prior to that point. So for example, if you had an ongoing business and you had a loan and there were intercompany loans and they were paying the investors instead of you would want the ability to declare your default, maybe put a receiver into the company, have that receiver go and enforce those subordination agreements and claw that money back and bring it into the company. And you could do that within a state court proceeding without a bankruptcy, and that can be a very powerful and effective tool. So that clawback provision certainly applies. Now, in the bankruptcy context, if there are distributions made that result in insolvency, certainly those are clawback. If there are payments made that result either in the dissolution before all creditors are paid, those can be clawed back. There are a variety of legal protections that give you those types of rights and remedies, but again, those are things you rely on as last resort. They're not things that you rely on in terms of being a proactive lender. So we would recommend the use of subordination agreements so that you can be a proactive lender and exercise some control before you get to the worst case scenario, which is where some of these protections come into play.
Brent, structurally, you have a holding company and 4 or 5 operating subsidiaries.
Yes.
That kind of move money back and forth between each other based on working capital needs, cash flow. How do those comments relate to that kind of scenario?
Well, that's a good question. Part of that is going to be dependent on what their organizational documents allow them to do. So, for example, if you have a parent company and the parent company is able to take in income and then distribute out to the entities, and they are following those corporate formalities, then certainly you're going to want to look at that and see if you want to impose any contractual controls, because that on its face is not improper or illegal as long as their documents otherwise allow them to do that. You can be fairly generic in your organizational documents and give yourself the right to make those kind of intercompany transfers as long as you're not doing it to otherwise defraud creditors. But if you're doing it assuming it's in good faith to help all of the entities continue to operate. So you'll want to look at that. Now here's what's going to be interesting is, if you have chosen not to make those related entities guarantors so that they don't have some skin in the game and you don't have consideration, the degree to which you limit what they can do and not do is really going to be dependent on whether or not you can establish there's a sufficient relationship within these parties that they have consideration for giving a subordination agreement, or whether they have a sufficient consideration for giving a guarantee where you can build in subordination provisions within the guarantee. And the basic rule on that, I would say, is if I look at an organization chart and I see that I can draw a direct line where monies can flow back and forth between the entities so that they have a benefit or a potential of a benefit, then you have a structure that you likely can get a subordination and or a guarantee agreement, and there will be sufficient consideration. Now, I know in the bankruptcy context, the original rulings in the TUSA case seem to indicate that downstream and upstream guarantors couldn't be giving these kind of guarantees and that they were not enforceable. What most people don't know is ultimately most of those rulings in TUSA were eventually overturned. And so some of those limitations that people have been very, very worried about have been eroded in subsequent appellate decisions. And so one of the things is we do want to carefully look at the relationships, and I have had situations where I've looked at an organizational chart and the plain reality is there's no line that connects one side of the operation to another side of the operation. You may have a group of investors who form an operational arm and then an ownership or investment arm. And if they ultimately are not transferring or have the ability to support each other with the transfer of funds, but they keep a wall between the two, you probably then don't have a situation where you have consideration for them to give you a valid subordination and or whether you can get a guarantee from that entity. So in that case, your recourse really has to be covenants and controls with your borrower entity. And you need to manage what they're doing and try to make sure that you are creating strong enough covenants and specific enough covenants that they can be enforceable. Because you're probably not going to be able to bring that third party, even though they are generally related or have some common ownership, if you can't draw that line of economic benefit between them. Good question. Some final thoughts before I get very specific into bankruptcy, and this is where I get to my circumlocution, so hopefully I've taken you in a full circle, and that is there is creativity available to lenders with each of the entity types. There is no right and wrong answer. There are just issues that have to be attended to, and each entity structure imposes limitations both on the owners of the entity and on the lender in terms of what they can do in terms of controlling that entity. Here's where you want to be at the end of the day. You want the ability to be able to approve or disapprove changes. You want the ability to approve or disapprove Loans, distributions, you do not want to be dictating to your borrower what they should be doing, but rather you want to put yourself in the position where if they take an action, certain actions are subject to your consent. If you do not specifically say that your consent is in your sole discretion, the law in nearly every state will imply that your discretion will be exercised reasonably. So understand that silence equals the reasonableness test.
That's an expensive word, reasonable.
Yes, because it's built in. Reasonableness is built in. So if you want to make sure that you want to be able to exercise an arbitrary decision in a commercial transaction, as long as it's not a bad faith decision, you can be arbitrary, but you must be specific and say sole and absolute discretion. Let's talk a little bit about guarantor recourse, because this ties in with the entities, and you've anticipated some of this in terms of asking me about guarantees by general partners. So we want to talk about there are really three types of recourse in the guarantor situation. There's statutory limitations on recourse. So one of those statutory limitations that we described is in real estate secured loans. If you have any real estate as part of the collateral package, and you're in one of those states that we've enumerated that has one action or anti-deficiency protections, the way you exercise or the order in which you exercise your right against the real estate controls the type of recourse that you can pursue against the borrower, or in some cases even against the guarantors. Classic example is in one action rule states, they are all deed of trust states. So if you exercise your option to pursue a deed of trust foreclosure, you are also making the decision that you are not going to seek any deficiency or liability against that borrower entity beyond your real estate collateral. But if you have true third-party guarantees, your guarantors can nonetheless be liable even after a trustee sale foreclosure for deficiency or additional liabilities. And we'll talk about how you do that. So those are statutory limitations. You can have de facto limitations by the structure of the entity. The classic de facto limitation is a single asset entity. You can have a fully recourse loan against an LLC, but if you say that LLC can only be a single asset entity and only own this piece of property or these assets which are pledged as your collateral, effectively you have a recourse limitation, right? Because all you can go against is your collateral, because you're not allowing them to own anything else or have any other interest. So that is a de facto recourse limitation. And finally, you can have contractual limitations on recourse. That's where you, for example, structure a guarantee where maybe you have a 50% repayment guarantee that, depending on certain performance, can burn down to 25%, 10%, or even in certain instances, burn down to 0%. You can also structure guarantees where you have a sliding scale. We have a lender that is a life company, and they always get guarantees that start off with 50% repayment guarantee liability. If the property achieves a 1.25 DSCR, because they only make term loans on income properties, if they get a 1.25 or above, that can ratchet down to 25%. If they get to 1.5 or greater, it can go to 0. But if during the life of the loan that slips, then the liability can come back and it can increase. And as long as you're specific in how that sliding scale moves up and down, it is absolutely enforceable. So you can be very creative and create a sliding scale depending on the performance of the assets, where you can protect yourself based on your collateral package, but if the performance of that collateral slips, you can increase the personal liability. So those are the types of contractual limitations. Recourse against third parties, you want guarantors. Guarantors have to have some skin in the game. What does that mean? Here's an example. Me and Jim Kuselis are partners. We're in an LLC. The LLC owns an asset. We pledge that asset, and the bank asks us to sign personal guarantees. We obviously have skin in the game. We can sign a guarantee. But let's say that Jim and I don't have enough financial wherewithal to make us attractive, but Jim's father is super rich. And Jim's father says, I'm going to help you boys out, and I will sign a guarantee. Unless Daddy's going to get some kind of benefit from the entity and the performance of that entity, his guarantee is a gift, and therefore it is unenforceable. Now, you can actually set up a pay-to-play situation, meaning you can take a party that doesn't have an ownership interest, but say that if we achieve a certain benefit from this entity, we will pay you a return for giving us a guarantee. That actually is consideration sufficient to give you a binding guarantee. So if we say to Jim's dad, you know what, if we make more than 10%, I've lost my picture here on our screen. Can everybody see the picture on your screens?
Yep.
Yes.
Yes.
Okay, good. Well, we kind of lost it here, and I don't know what I've done. I don't think I touched anything. No. Okay.
Here comes you guy.
Well, yeah, we've lost the picture here. I just want people to see it. I don't know what's happened to it. We may have timed out, but as long as the people on the webinar can continue to see it, I will plug forward. Yeah, they said they can see it, so we'll keep plugging forward. You can actually have a pay-to-play situation where you can give consideration for the sole purpose of getting a valid guarantee.
That's a question.
Yes.
So let's assume you had 3, 4, 5 partners or even 10 partners, and typically when you want a guarantee, they're going to say, well, we don't own a majority, and therefore I'm not going to give you a guarantee. So is there any issue, do you see any issue with asking for a guarantee from one of the guarantors, let's say the majority guarantor, which is only 30%, and he's going to say, well, I'm not going to do that, why should I do that? But then if the company was to pay him, let's say guarantee fee, call it whatever you want, guarantee fee of $10,000 a month,
Or give him a preferred return or first dollars out or something like that.
Yeah, simple, just say dollars.
Yeah.
Guarantee fee of $10,000 a month for that. Now he's got a reason to say, well, I'll do that.
Yeah.
Is there any problem with that structure?
No, not from the lender's standpoint. They certainly can create their own incentives. And let's take the example where you have 10 members of an LLC.
Well, I'm not thinking about lenders. You know, we get what we want, but is there any legal issue with structuring it that way?
No. In other words, the members can go ahead and agree within themselves, particularly when you have an LLC. You can agree with between yourselves how the economic interest may differ from the ownership interest, and that is permissible. Now, there are limitations when you're dealing in the corporate format where you can't necessarily do that unless you have preferred shares or different classes of shares. But within your classic LLC structure, you can go ahead and have different economic interests than your ownership interest, and there's nothing improper or impermissible about that. I also want to make this point is, let's say you have 10 members, one of them has 50% ownership, and then you have 9 people who split up the other 50%. You can pick and choose who you want to have as guarantors. In other words, you can ask one of them to be a guarantor, you can ask them all to be guarantors, you can allocate their liability based on their ownership interest. You can make them joint in several. If you make them joint in several, you can pick and choose who you're going to enforce against, and it's up to them to then equalize in their relationship between each other when the dust settles. So as a lender, you are not restrained by how they've organized themselves in terms of who you pick as a guarantor or what type of guarantor liability you're going to impose on them.
Well, in your example of 1 at 50 and 9 at whatever it was, the balance, unlikely that would go to the minority, but go to the majority and just tell them, you know what, he's going to say, I don't want to do it. It's going to, usually the situation is, well, I don't own the whole deal. Well, pay yourself a fee and then do it.
Yeah.
So
and that would be perfectly reasonable.
Lender issues, maybe Bob's got an issue with it, but
yeah, I mean, certainly the investors may have an issue on that, but
they're getting something in return. Although
correct.
It's about 120 in my example.
Yeah.
That's right. One thing to keep in mind, one of these pay to guarantee situations, you know, we're looking to see where the consideration is for the guarantee, and if they're doing a pay to guarantee situation, let's take a look at the agreement. I'm actually in the middle of a transaction right now that's a construction loan followed by a mini-perm loan, and the party that's being paid to guarantee, in this agreement it says, I will guarantee the construction loan, but I don't want to guarantee the permanent loan. Well, the question is, this is the 3-year mini-perm, does it fit? When we asked the question, he came back and said, no, it doesn't fit. I'm not guaranteeing that. So, you know, make sure that there aren't any limitations to what they're willing to guarantee when you have one of these agreements.
right. Good point. I'm not going to really belabor, because I know we have a wide audience that includes a lot of states in the Midwest that don't deal with anti-deficiency or one-action rules. Let me just make this point. If you're making a loan in one of the enumerated states that has these types of protections, your borrower cannot waive those protections when they make the loan. They can, however, waive those protections as part of a restructure of the loan, as a modification of the loan, or as a forbearance under the loan. In addition, your guarantors, by judicial decision, have been given those same protections up front, even though the statutes do not extend them to the guarantors. The guarantors, by case law, get those same protections. The difference is a guarantor can waive those protections up front where the borrower entity cannot. So that's how you can have a situation where you have a true guarantee that you could sue on separate and apart from your real estate collateral, separate and apart from your remedies against your borrower entity, even in a one action in an anti-deficiency state, because all those protections are given to the guarantors by the courts. The courts do allow them to waive them. And in particular, in California and Washington, there are specific waiver language that you use, which is a safe harbor that you want to make sure you include in your documents. So that's the big point I want to make, is if you're dealing in states like Washington, Utah, Nevada, or California, primarily those are your one-action rule states, that's the distinction that you have to be careful of. We talked about de facto recourse limitations, so I won't go over that. In terms of contractual issues, rarely do we have recourse limitations. The one thing I do want to make the point of is talking about completion guarantees, and we'll talk about that in a second. We're at our 1 hour mark, so I want to be true. I want to be able to wrap up in the next, hopefully 10 minutes or so. So I don't want to rush through too fast. If you have a question, please ask it. I don't want to cheat anybody.
Quick question.
Yeah.
One action rule, if you're in California or another state,
Yeah.
where it applies, not a recourse issue, but if the borrowing entity has both personal property and real property, and you have a deed on the real property, can you go against personal property first and then after the real property?
Generally, you have to assume no.
Okay.
There are some exceptions. Here's an exception. There's a carve-out in California for letters of credit. So, for example, if you're given a choice between getting a letter of credit pledged as additional collateral or cash pledged as additional collateral, you want to take the letter of credit. The reason being is letters of credit are owned by the holders. Cash, even if it's pledged, is still owned by the original pledgor. So in a bankruptcy context, a letter of credit is not part of the bankrupt estate. But cash is part of the bankrupt estate. So a letter of credit is better, and in California, it's specifically carved out. But for example, if you're dealing in any one of these states, you want to be very careful if you have cash collateral, if you have other personal property collateral. Generally what you want to do is you want to bring a judicial foreclosure lawsuit and have a receiver put their arms around all of that collateral, and then have the court give the receiver the right to do certain things with the personal property collateral, because that's your general protection in those instances. You do not want to be unilaterally taking that cash and paying down the debt. Now here's the exception. The exception is if you have an agreement after the default has occurred. So let's say you take cash collateral up front, and then you have a default. And the borrower expressly after the default says, you know what, I want you to apply that cash to pay down the debt to help me work through this situation. A post-default agreement is enforceable and is not a violation of the one action or the anti-deficiency rules. So you can say up front in your document, after an event of default, we can apply the cash. You need to be careful in that instance. But if you get that very same agreement reaffirmed after the default, then all of a sudden you're free to use the cash. So be careful in that instance, and you want to be careful with that. In terms of limited recourse, the points I want to make are, even if you're doing a payment or partial payment guarantee, my recommendation is get your bad boy carve-outs in addition to your payment guarantee. Why? A payment guarantee is exactly that, repayment of the loan. There can be other things that the person does with your collateral or with your interest in the collateral that can be above and beyond repayment of the loan. It can also be something that has nothing to do with the repayment of the loan, like taking insurance proceeds that you have a collateral interest in, but they instead use that money to go on a vacation to Mexico. You want to have the right to specifically go after those assets, and a repayment guarantee does not give you that. So my recommendation is, even when you have a repayment guarantee, whether it's a partial or full repayment guarantee, get your bad boy carve-outs, because they do give you something separately enforceable that is greater than your repayment guarantee and has value above and beyond your repayment guarantee during the life of the loan. Another good example is if you have a repayment guarantee and that's all you have, and you find out that they've misappropriated rent. You may have a covenant violation, but you may not want to call that as a default under the loan, right? Because you're thinking, gosh, this is a covenant violation. Do I really want to call that as my default? But if you have a bad boy carve-out, all of a sudden this becomes a payment default now, because they've misappropriated those funds and they have to pay those back to you. And if they don't pay those back to you, now you've taken a covenant and turned it into a payment default. So I recommend that even in situations, you always get your bad boy carve-out, okay? Springing recourse. Springing recourse is fully enforceable both in the bankruptcy and in the state court context if you're specific as to what the trigger is for the springing recourse. The courts, through this recession, in multiple jurisdictions, both on the federal level, in the bankruptcy context, and on the state level, have upheld springing recourse provisions. So if you want to say you have no recourse as a guarantor until you do X, and then you have full recourse or partial recourse, those are enforceable both under most state law and in the federal law context. Recourse burn-offs, that's an alternative as an incentive, and you can tie those to the performance of the property, and like we talked about, you can have sliding scales. I just want to talk about some alternative types of guarantees. We've talked about payment guarantees, which can be full, limited, springing, burn-off. Completion guarantees. Here's the point I want to make about a completion guarantee. You want to make sure your completion guarantee does two things. One is you want to make sure it expressly says that the potential liability for completion may be greater than the repayment of the loan. Because if you do not expressly recite that, you could be left with a completion guarantee that is less than what you bargained for. Meaning you can have a situation where it can cost another $5 million to complete the project, but maybe they only owe you $4 million on the loan, and that's what you would be capped on unless you expressly recite in your guarantee that the damages can be greater. The other point I want to make is you cannot force somebody to complete a project for you. So you must have some kind of damages provision in your completion guarantee, because the 14th Amendment does prevent us from enslaving somebody to do work for you against their will. So you cannot enforce a completion guarantee by specific performance and say, pick up your hammer and build that project. So one of the things we have started advocating is to consider, not only do you have a way to liquidate your guarantee, which we've always put in our completion guarantees, but maybe that you have a calculation of an actual formula. And we're happy to talk to you about formulas we've used, but we actually have them in the form of like a liquidated damages provision, which says that if you do not perform, here's exactly how we're going to monetize the loss under your completion guarantee, and then you have to pay that amount. And that is a very powerful tool in the completion guarantee context. Another form of guarantee is an LTV maintenance guarantee. In other words, a guarantee that says that if the value of the asset declines, that the guarantor will cover that gap. Similarly, we have debt service guarantees, which aren't repayment guarantees. They're actually more valuable in certain instances because they say that on an ongoing basis, if the debt service isn't being maintained, that your guarantor will be paying that debt service. The value of that is those are guarantees you can bring on, those are actions that you can threaten on a serial basis, meaning it's not a one-shot only like a payment guarantee. Payment guarantee says, I'm done with you. Pay me my loan. A debt service guarantee says, the property can't support the debt service, come out of pocket. But then they can come out of pocket, the property can start to rebound, and then down the road, it can falter again because you lose tenants or whatever. You can go under them under that same guarantee. You haven't lost your option. It is a continuing obligation. We've already talked about the waivers of the various protections that you can get in guarantees. I just want to make the point and to wrap up that we've talked about enforcing guarantees. We've talked about true guarantees. We've talked about consideration for guarantees, and we've talked about the inclusion of bad boy carve-outs. Unless there are any questions, we've kind of covered those. We've also talked about funding or equity agreements, making those direct obligations that you get with third-party investors. Even though you are getting a direct obligation, you should, in your mind, think of this as a form of potential guarantee, right? So you want to get all of your guarantee waivers in your one action rule states, even though you're getting a direct obligation. So you say to your investor, if this property needs an extra $10 million, you're going to kick it in, and we have the right to call directly on that, in a form that can be viewed as a judge as a backdoor guarantee. So we always include in our equity funding agreements all of the guarantee waivers for your protection. Similarly, if you have a third-party pledger of assets, just like a guarantor, that third-party pledger has to have some skin in the game. So in my example, if Jim owns a piece of real estate and we're making the loan to the LLC, he can pledge his personal real estate as security for the debt. But his generous father cannot pledge his real estate unless his father's getting some kind of return. And again, if you're having a third-party pledge, even if they have consideration, you want to recite in your deed of trust that they are waiving all of the guarantee protections, because again, a court could look at that third-party pledge as being a form of backdoor guarantee. So we always get those protections in the third-party accommodator situation.
Want to talk about co-borrowers real quick?
Real quick, go ahead.
Sure. I would view co-borrowers in the same situation, because a friend and I are both borrowers, or LLCs are both borrowers, but we're just pledging my property. It can be viewed that I'm guaranteeing my property is used to guarantee the debt that Ren's got also, so it would also include the same third-party accommodation language in there.
Yeah. Finally, because I'm coming up on the witching hour of 75 minutes, and I pledged to Peter Wimmer that I would keep us within 60 to 75 minutes, and so I will live with that pledge. I just want to throw out some alternatives that can be protections. Cash management agreements, whether they're springing or soft lock boxes, hard lock boxes with waterfall provisions, reserves that you take and you hold in pledged accounts. Those are all alternatives to guarantees or alternatives to recourse against parties. Financial covenants can trigger defaults, but you generally can build in the right to specifically perform those. But I really think what you want to do is you want to design your covenants so that your covenants have a monetary aspect ultimately, so that you can have a payment default at the end of the day to enforce, as opposed to just a covenant default. We've talked about some of those ways to do that. Yes?
Any possible issues of one action when you go against reserves?
Absolutely. You have to treat reserves the same way you do as pledged cash collateral. You even have to, even though this is a depublished case in California, in 1988, there was this case called Post Federal Savings versus, I forget whoever it's called. It's depublished, meaning you can't rely on it as authority. But in that case, there were pledged rents. And the lender started collecting the rents without foreclosing on the real estate. Now, we do have, in California now, specific statutory carve-outs, like the letter of credit example, that says if you have an absolute assignment of rents, and if you follow the statutory safe harbor language, you can actually collect those rents without triggering the one action protections. So you need to be very careful with that, but reserves are not entitled to those same protections, and you need to treat reserves like any other pledged cash, and you need to be very careful and not apply those unless you're applying them, exactly the way the documents say. So if you have reserves that you apply for maintenance, for repairs, for things like that, you can continue to apply those reserves pre and post default that way. But if what you're looking to do is apply those reserves to now pay down the principal on the debt after default, unless you get a post-default reaffirmation, I would recommend you be very careful and use the receiver to protect you in that instance if you don't get that reaffirmation. So treat reserves that way. But post-default, if you want to use those reserves to pay insurance premiums or use them for repair or maintenance or other things to protect the collateral as provided in the document, you can continue to do that. Your risk is applying it to pay down the debt, not applying it to protect your collateral.
Interest payments.
Same thing, that's your debt, so you got to be careful with that. Anything that's debt related, You got to look at that as a one action issue. Anything that's collateral related, you can go ahead and feel like you're in a safe harbor there. That's just a great classic distinction for you. Again, final thoughts, really not much different. A lot of room for creativity in guarantees, a lot of room for creativity in cash management, reserve, and other type of recourse beyond the borrower and its assets. What I want to leave you with is the idea, and I've had some discussions with some of you in your network already. Call us up if you have a situation. We don't open a file when you call us up. We don't turn the meter on like a cab. You won't hear the ticking of a time clock in the background or the sand moving through the sand dial. Jim Kouslas and I love to take your calls, and I put on these sheets our contact information. Call us up. Spend 5 or 10 minutes. Talk about your options. Think about it. Let us help you protect yourself up front when you're at the term sheet stage, when you're at the LOI stage. That's where we can give you 5-10 minutes of free good thinking and help you get the right structure up front. And we are always happy to do that. And that's what we want to leave you with here is you've got a lot of options, but it's a little bit of a minefield. So call us first and let us help you negotiate through that, because we can give you maybe 2 or 3 options that you can negotiate with. Then send us the term sheet and we'll take a look at it. And we'll make sure that you've worded it correctly. And all that we do as part of our sweat equity in terms of our investment in you. We want you to be successful. We want you to be profitable. And so we figure this is our investment in helping you do that. So with that, I end the presentation. If there are any questions, I'm happy to field those, but I am at 78 minutes. So Peter, I have let you down by 180 seconds here.
Thank you, Ren.
Well, thank you everybody for joining us. We hope to work with Peter in the future to design future programs. I hope that this has answered questions that are top of mind for you. If you have follow-ups, contact us. We're happy to talk through them. Thank you everybody, and we will sign off now. And I appreciate your participation. Bye-bye.
Thank you.
Thank you.
Bye.